Welcome to this episode. In this video, we will discuss two ways of using the Bollinger Band indicator to earn you consistent profits. This strategy is advantageous as it gives traders a better idea of future market trends. It is also a great way to increase your trading profits, and I'm sure you will make lots of money from this technique. To make sure you understand the material, I have done a lot of research for this video. To start, I will explain the theory behind the Bollinger Bands strategy. Then, I will show some examples to demonstrate the effectiveness of this technique. As an aspiring trader, you should watch the entire video to make sure you don't miss any important information. So, please stay with me. I'm confident that with this knowledge, you will be able to use this strategy to become a successful trader and make lots of money. Here is some very important information I need you to know before we start. Everything we talk about in this video can be applied to both currency, stock, and cryptocurrency trading because price action is pretty consistent across different trading assets. Therefore, we are going very in-depth in this video. You can use this for any type of trading. Now, let's get started. John Bollinger developed the Bollinger Bands, which are a technical indicator used to track the standard deviation of a simple moving average. The Bollinger Bands consist of three lines. The middle line is a 20-period moving average, and the upper and lower lines are two standard deviations above and below the 20-period moving average, respectively. The upper and lower lines are also known as the upper and lower bands. The Bollinger Bands are a popular indicator among traders because they help determine whether the price is relatively high or low. In this video, we will use the Bollinger Bands with their default settings of a 20-period moving average and a 2 standard deviation. The distance of the bands is determined by the standard deviation, so they adjust to the volatility of the asset. This means that in a sideways market, the bands become tight. In a trending market, the bands become wide. Approximately 95% of price action is contained within these bands. If the price comes close to the upper band, we can assume that the price is overbought and may reverse downward. Likewise, if the price is near the lower band, the price can be seen as oversold and an upside move may be expected. However, this isn't always the case. In a strong uptrend, the price can stay near the upper band for multiple candles, and in a strong downtrend, the price can stay at the lower band for multiple candles. One way to use Bollinger Bands is to set stop loss and take profit levels. For example, if you place a buy order at the point where the middle band crosses, which is calculated using a 20-day moving average, the upper band could serve as the target price. Similarly, if you initiate a sale at the middle band crossover, the lower band would represent the target price. Now that we have a solid comprehension of the Bollinger Bands, it's time to focus on our first strategy. The squeeze breakout strategy is based on the premise that the market moves from high volatility to low volatility. Thus, when we identify a period of low volatility, we can anticipate a large move in either direction. Our aim with this strategy is to capitalize on these big moves. For this, we will first need to find low volatility areas. When the market is experiencing a phase of low volatility, it is reflected in the appearance of the Bollinger Bands. Specifically, the middle band appears as a straight, horizontal line, and the upper and lower bands are extremely close together. This represents a lack of significant price movement and indicates a low volatility period. With this recognition, our first step towards identifying low volatility market conditions is accomplished. The next step in the strategy is to wait for the market to make a trending move. This trending move can happen in either direction. According to the strategy, when the price closes below the lower band, we should sell. Likewise, when the price closes above the upper band, we initiate a buy trade. To demonstrate, you can here observe that the price closes above the upper band, resulting in a buy trade. However, the price then unexpectedly falls, indicating a false signal. But do not fear, there is a solution to reduce the frequency of false signals like this. Bear with me. For this, we must go back to step 1. In order to reduce the occurrence of false signals during a low volatility period, a strategy of marking horizontal support and resistance levels is employed. This provides a clear boundary for the price to cross in order to establish a trend. When the price breaks above the established resistance level and closes above the upper Bollinger Band, a buy trade is initiated. This is considered the entry point, and the stop loss is placed below the resistance level. As for profit targets, a risk-to-reward ratio can be used to determine the exit point. For instance, in this scenario, after entering the trade at the specified conditions, the price moved upwards by $120. Now, let's examine a sell trade using the S&P 500 stock on a 30-minute chart. In this area, we observe that the middle band is flat and the Bollinger Bands are narrow, signaling a period of low volatility. To further confirm the trend, horizontal levels of support and resistance are marked. For the price to establish a trend, it must break through these levels. In this case, the price has broken below the support and the close of the candle is below the lower band. This is considered the entry point for the sell trade, executed at the close of the candle. To minimize risk, the stop loss can be placed above the support area, and profit targets can be set using a 2-to-1 risk-to-reward ratio. As a result, the price experienced a downward movement of 80 points after the entry. It is important to note that while this strategy is effective on 15 and 30-minute time frames, it is recommended to test it through backtesting before implementation. Before we move on to the second Bollinger trading strategy, please give this video a thumbs up, turn on post notifications, and subscribe. I work very hard to provide you with great content, and your support really means a lot. Anyways, let's now move on to the second strategy. The second trading strategy we will look at is called the RSI Bollinger Band combo, which involves the utilization of two technical indicators, the Relative Strength Index and the Bollinger Bands. The RSI will be used with the default 14-period setting. The objective of this strategy is to detect divergences in the RSI and then utilize the Bollinger Bands for entering and exiting trades. Divergences, which come in two forms, positive and negative, are important to understand in this strategy. A positive divergence occurs when the price makes a lower low but the RSI shows a higher low, signaling that the downtrend has a weakening momentum and possibly a reversal may happen shortly. Conversely, a negative divergence occurs when the price makes a higher high but the RSI shows a lower high. This indicates an exhaustion in the uptrend and a reversal may happen shortly. It's important to note that not every divergence results in a reversal. Let's now dive into the Bollinger Band combo strategy. To start, we must search for divergence in the chart. As we observe the chart, we see that the price has made a series of higher highs. However, when we look at the Relative Strength Index, we observe that it has made lower highs. This phenomenon, known as a negative divergence, suggests that the upward trend has lost momentum and a reversal could be imminent. To confirm this possibility, we wait for the price to close below the middle band of the Bollinger Bands. Once this occurs, we sell the stock at the close of that candle. We keep our stop loss above the upper band and set our targets at a 2-to-1 risk-reward ratio. The stock had a 2% move in the hours following our entry. Let us now take a look at a buy setup. Here, you can see that the price has made lower lows but the RSI has made higher lows, indicating a loss of momentum in the downtrend. Before we make a move, we wait for the price to close above the middle band of the Bollinger Bands. When this happens, we enter at the close of that candle. We keep our stop loss below the lower band and set our targets at a 2-to-1 risk-reward ratio. As you can see, this was a profitable trade. It's important to note that the Bollinger strategy is just one of the many strategies that traders can use to trade in the market. It's always good to use multiple tools, indicators, and strategies to get the better understanding of the market and make informed decisions. You stayed through the whole video. Well done, I'm very proud of you. If you learned something new, make sure you like this video, turn on notifications, and subscribe. That way, you will never miss out on more awesome trading videos. Make sure to check out my video about the Heikin-Ashi trading method. In my opinion, it's one of the best methods I know about. Click here to watch it. See you in the next video.